the euro has been the FX story of the last few months. That was after a long period of very, very range-bound trading, and we've had a very clear and a very trending move to within last week a whisker of this 120 level. And we've got to remember that FX, as always, is a relative game. And I think over the last months, we've seen compelling macro cases, I think, on both blocks that have supported that move. You mentioned the EU Recovery Fund, and I think historically the euro has been blighted by this perception of the left tail risk, and I think the Recovery Fund and a proactive ECB has helped to turn this story into a bit of a game changer. I think underlying flows are also important. So the narrowing of interest rate differentials post the Fed, post the recent Fed cuts, has led, I think, and will continue to lead to changes in hedging behavior that help to underpin the euro. And we also think there is room for investors to increase longer term allocations to Europe and the rest of the world, which we do think will be supportive. Now, look, clearly, any concerns around wave two, continue to be something that we will closely watch. High frequency data, particularly global mobility metrics, have had a strong correlation with FX market price activity, so that's important. But from what we see at the moment, I think wave two, not quite as much as a concern as the initial wave that we'd seen earlier in the year, but obviously to the extent that has potential to undermine, the euro case, we have to keep a close eye on that. But it's not our core case. We continue to hold a 1 year forecast of 120 in the euro, and that we came up with that forecast as of late June. We think any dips down towards 117 and then again down towards 115 will be a buying opportunity for the euro.
High frequency data, certainly the name of the game for everyone at the moment, it seems. And back to Asia now, you're arguing that the USD Japan yen has been surprisingly out of focus in recent months. Make your case for why we should put it back in focus.
So look, I think the yen is a really interesting one. As you said, it has been out of focus, but I do think there's a really, really important message that we need to deliver here. And particularly amongst the private client community that we look after, clients have tended to lean long of dollar yen in the last few years, and both as a trading position, but also as a way of accessing cheaper borrowing via that lower yielding currency. And historically, if the trade moved against you, you could always sit and collect the carry. We think now we're in a different part of the cycle in terms of the way we expect dollar yen to behave. And that reflects somewhat the view that we're seeing a little bit of a reshuffling of reserve currencies. So i.e. dollar yen, from having been, at least from a private client perspective, a buy on dips for the last few years, we think is actually turning into a sell on rallies. And there's a couple of reasons why we think that. First of all, reduced interest rate differentials between US and Japan. We think that makes Japanese investors more likely to hedge their dollar exposures. And the second thing is that to the extent that the main driver of yen weakness at points this year has been a reallocation to foreign investments by the GPIF fund, as well as FDI outflows, we think those forces are going to become less important over time. So, whilst dollar yen has been a little bit range bound and perhaps surprisingly so, we think the risk is still for dollar yen lower. We've got a forecast, a 1 year forecast of 102, so we wouldn't be surprised to see a move down towards 100. So, I think that's an important message in terms of the way we're expecting behavior to change, and we think particularly our private clients need to be aware of this.